Thank you for joining us, everyone. Welcome to our uh, Q4 2024 quarterly webinar. This one goes over tax-efficient strategies for charitable giving. You may have seen some of our announcements on this particular topic. We specifically are going to go through the tax advantages with charitable giving, how it can relate to your financial plan, and the overall benefits of you making those charitable donations and the impact of those donations as it relates to both your charitable giving goals and your alignment with your overall financial plan. So this is personally one of my favorite topics, and I'm looking forward to presenting everything that we have here in the material today. First of all, just want to go over a quick disclosure. The ideas presented here today, they are for presentation and education purposes only. They should not be relied on for education or for investment or tax or legal advice. And they are to be evaluated with your legal counsel and with a qualified financial planner. All right. Well, as you may have noticed already, the title of our webinar this evening is the 3 strategies for tax-efficient charitable giving. So, charitable giving really encompasses a wide variety of types of the type of giving you can really pursue. In this particular webinar, we do talk about how to donate to churches. Really, this does apply, though, to any type of a public charity. And a public charity is one that is classified accordingly and can be found on the IRS website. It's an important distinction to note that there are some different tax limits as far as deductions that you can take. But by and large, as long as you are doing it to a qualified charity, then those deductions will stay in place for you. These rules do not apply the exact same to endowments or to private charities. So just keep in mind that there are a couple different rules that you want to look at, and looking at those with a CPA can also help to make sure that you're taking advantage of the proper types of deductions that you're allowed to take. So let's just go over a quick overview. What this is going to just give us is just kind of that roadmap and to guide us towards really what our end goal is, which is making sure our giving is doing the most and making the most impact in our financial life. So first of all, tax efficient giving allows us to accomplish really most, or if not all, of our charitable giving goals with added tax benefits. So you might think of it as the icing on the cake. What that will do is not only just give you as the donor a added tax benefit, but by not increasing your overall tax burden, that does free up your funds to possibly increase or make even a greater gift to the charity that you are most passionate about. There are a couple of strategies that can be combined that may be a really good useful tool for you in a high income year, or maybe other types of overall financial situations where a larger deduction is needed in one year. Those types of things can be optimized by still allowing you to accomplish those charitable giving goals that you are most passionate about. Age, income, amount of those gifts, those are all factors that can be intertwined to really make sure your giving goes the farthest. And lastly, just make sure that you're considering your charitable giving strategy in light of your overall financial plan. Rarely is it as effective as a standalone strategy. Although you can accomplish a lot of things with just looking at the tax benefits alone, there are a lot of different things that you do need to really take a zooming out approach on and really look at it in a longer term view and in light of other types of financial goals that you have, things that maybe align with your estate plan as well. Those are all different ways that a charitable giving plan can complement your overall financial plan. So let's go ahead and look at our first strategy. Our first strategy is one that's been around for quite a while and is very popular and can be really implemented in a lot of different cases. However, there are a few things that can have some working parts to them. So we want to make sure that we're looking at this properly as it relates to if it's the best solution for you. So the first one is going to be transferring a publicly traded security. So this can be one or more securities. Security, just to make sure that nobody's lost in the jargon, is simply an investment. So an investment can be a mutual fund, it can be a stock, it can be an ETF. Any of those really qualify as a publicly traded security. So here's just some general points as it relates to donating this type of investment. So the reasoning for this is really to make sure that people are aware of just the overall the greater, more flexibility that you have when donating investments as opposed to cash. Many people assume that cash is really the only way of giving, and a lot of times it is a very simple way of giving, but it may not be the best for both you or for your church or charity that you're trying to benefit. Um, a statistic on this particular point is that cash only accounts for about 7% of the wealth in the US. However, it makes up about 85% of any charitable donations that are actually given to a church or charity. So there's a large swath of the actual wealth that is accumulated among the American population that is not actually being donated directly from. And as a result, we know that investments typically tend to increase in value. And when they don't increase or when they increase in value and you take on that tax burden of selling that asset, you also pay the tax on those gains. A publicly traded security, like we mentioned, are really any type of investment that you can buy or sell, whether it's electronically or whether you use an actual broker to do that. Those are all investments that are traded on those exchanges, such as the New York Stock Exchange, the NASDAQ. Any of those types of investments can really be transferred between different brokerage accounts to different owners. So the reason for this, again, is that a publicly traded security is very efficient. They're very transparent, and can be easily transferred amongst different firms. So as far as the guidelines to donate these shares, investments that are in a non-retirement account are those that can be donated directly to charity, as opposed to those that are in retirement accounts. So anytime an asset leaves a retirement account that's coded as a distribution, that could be taxable depending on your scenario. However, investments that are in those non-retirement accounts, they're treated differently, and those are treated to be taxable upon the sale of that investment, not upon the distribution from the account. Non-retirement accounts can include your individual accounts, joint accounts, non-revocable trust accounts. Those accounts are reported directly on your tax return under the Social Security number of that account owner. And so, how that basically facilitates a change of ownership is that just simply transfers from that one tax ID or that one social to the beneficiary or to the recipient, and then that becomes the owner of that investment upon the transfer. This does require that the charity has a brokerage account that's set up in the name of that church or that charity. Um, there is another option that's available for that through the use of a donor advised fund. We'll cover that more in our strategy on the next couple slides here. However, if they do have a brokerage account, what can happen is that you can just go ahead and initiate that transfer. That is done directly from the brokerage account, or I'm sorry, the brokerage firm that you hold that account through. And those shares do get sent directly to that church's or that charity's account at the receiving brokerage firm. So it can be used, if you want to think about it similarly to transferring funds between different banks. Brokerage firms operate on a similar system. It's called the DTC system, and referred to as the Depository Trust and Clearing Company. So, just to kind of continue to expound on the reasoning for transferring investments from a non-IRA or non-retirement account, anything that's really increased since you bought it can be evaluated as a potential donation candidate. So there are, again, some IRS rules depending on how much that investment has appreciated and how much the adjusted gross income is of the donor in terms of how much you can actually deduct on your personal taxes. However, typically this rule of thumb is the more it's gone up, the better it is to donate that. Again, because that sale is what's going to trigger those tax implications. The IRS is going to look at the date and the amount that you bought that security for, and that's going to be subtracted from the current market value of that security, and that's going to be referred to as your capital gain. When that capital gain will be reported on your taxes, and that's what you pay that tax on. However, if you do go ahead and donate those shares directly, that gain goes with those shares and is transferred directly to that church or that charity. And what that does is essentially transfers that tax liability to the recipient. Now, the nice thing about those churches or charities is that they are a nonprofit, so they do qualify under that status to not have to pay income tax. So even though there is a gain on that particular investment, the way that this works is that does qualify under that 0% tax rate to be able to realize those gains once that's in that church's name. If you do end up selling that investment, again, those capital gains taxes can range anywhere from 0% up to 20%. There is a very small window of gains that can be taken at a 0% tax rate for individuals, whether you're single or married filing jointly. Also, minors can qualify if they don't have much income to not have to realize those capital gains as well. However, again, if a gift is in your mind or if that's something that you have on your agenda, this can be a great way to not have to worry about actually getting any type of a gain on your tax bill or on your tax return, and then just simply transferring those shares directly and alleviating that completely off of your return. So on this slide here, we're going to talk about how that really impacts you with those numbers. So really, stocks can be any publicly traded investment. So we use the term stock here loosely. That's again that investment that you hold in the side of that non-retirement account. So really what we have here is a comparison of those two different types of donating strategies. On the left, we see here where the donor is just going to go ahead and sell the investment that they're looking to donate, and we're just going to send that cash directly to that church or that charity. So in this case, we paid $60,000 for this investment. Now it's appreciated by $40,000 and it's now worth $100,000 in terms of market value. So on the left, we're going to go ahead and that donor, they sell that stock or whatever types of investments they own based on their tax bracket and long-term capital gains taxes. That total tax that they would have to pay on that sale is about $9,520. If we subtract that from their gross sale. That leaves them with $90,480 left as that net transfer to the charity. If we take that on the right here, we're just going to go ahead and transfer that entire market value of that one stock or multiple stocks directly to the charity. Since we're not selling that, there's no tax reported on our personal tax return. We do just value that for charitable giving purposes to determine how much to actually put on our tax return as that charitable donation. But in the end, we get that total charitable donation on the entire amount that we give. So the additional amount we donated is essentially that tax that we had saved in that long-term capital gains taxes. Keep in mind that, again, this must be donated from a non-retirement account. So any types of IRAs or 401ks, there are some other options you can get from those that we'll go over. But this particular example is just going to go over those non-retirement accounts. All right. Moving on, we're going to go to strategy number 2, which is utilizing a donor advised fund. So a donor advised fund is a very useful tool, one in that tool belt, so to speak, that can be used for different times where maybe the strategy number 1 is not allowable, or again, as we discussed, that maybe that church or that charity does not actually have a brokerage account set up in their name, and we need to go about doing that in just a slightly different manner. So donor advised fund does actually give you more flexibility. However, there can be some additional maintenance and administration that goes along with that. So, however, this is also a very useful tool as it relates to donating. So let's go over, first of all, what really a donor advised fund is. So if you haven't heard of the lingo or not familiar with this type of terminology, really a donor advised fund can be viewed as your personal charity. And it is a controlled pool of money that's designated for those charitable purposes. So once essentially we get that into that donor advised fund, it is going to be used for charity. That is the purpose of those particular funds. And so as we get it in there, we'll talk about the different donations or deductions that we can get from that. However, it's designed specifically for those charitable giving purposes, not to be used to taken back out for personal use. So a donor advised fund is typically administered through a third party. So there are some tax reporting obligations that you have to make sure that you comply with. They're generally pretty light, but they are important to make sure that you do actually have that qualification as a donor advised fund. There's a lot of different big firms that offer them on a more corporate level. There are also a lot of private firms that will administer those on behalf of an individual client, or a married couple. But ultimately, the person who set up the donor advised fund is going to be controlling the amount that goes in and the amount that gets sent out of the charity or out of that donor advised fund. is in terms of how it operates. Any type of brokerage firm is going to operate this account very similarly to the rest of its investment accounts, whether it's an individual account, joint account. The look and feel is going to be the exact same. It's just that that tax reporting is going to be different in terms of getting that deduction when the funds go in, and then also too whenever the funds go out to those different charities. Those actually are qualified as grants, and so that terminology is fairly common in our society. And when we discuss charitable giving, a grant is essentially what comes out of that donor advised fund for the benefit of the charity directly or that church. In terms of investing, you can also invest these in various publicly traded investments, just like we discussed in the first example. If you own those in your personal names, those donor advised funds can be invested in stocks, ETFs, mutual funds, any of those types of vehicles. So let's talk about taxation on the donor advised funds. So in a donor advised fund, there's really two key transactions that classify when you're both putting the money in and when the money goes out. So the tax deduction occurs in a donor advised fund whenever the funds are deposited into the account. So whether it's through stock, whether it's through a cash donation, whatever that looks like in terms of putting money in, whatever that market value is or that cash value upon the donation into the donor advised fund is both the amount and the year in which that you get that tax deduction. So in our first example, if we did that $100,000 donation through publicly traded securities, and say that church did not have a donor advised fund, I'm sorry, the church did not have a brokerage firm set up, but you as the donor wanted to go ahead and donate to your church, you could donate those shares directly to your donor advised fund. Although that is something you control, it is not your personal assets anymore once you get that in there. And that does alleviate you from having to pay those capital gains taxes. Plus, you also do get a deduction in most cases upon the fair market value of all those shares. So you get that full value upon the date and the amount that you donate those shares directly to the donor advised fund. Once those funds are in the donor advised fund, you can go ahead and you can disperse them. There is no holding period in terms of length of time that you have to have them in the account. However, you do have to send those shares, or generally speaking, the charity that you're sending it to or the church can get those dollars in cash instead of having to get them in shares or another type of vehicle. So it makes it convenient for the end recipient of the church or the charity because they can essentially get those funds in readily usable dollars as opposed to having to cash them out themselves. Again, that grant is going to be sent out. The grant, it has no effects on your taxes, whether it's for the donor advised fund or for you personally. Again, that donation is made upon the transfer into the donor advised fund. And then once those grants are sent out, that has no bearing on your personal tax return when the funds actually get sent out of the donor advised fund. Again, publicly traded investments are eligible for in-kind transfer. So just like in strategy number two, I'm sorry, in strategy number one, there's a typo there. Sorry about that. That we can use those investments that have those embedded gains and avoid having to pay those capital gains taxes. So this does help to accomplish the same type of tax minimization that we talked about in the first strategy. Another item to note, if you do go ahead and use the share donation method, and let's say you deposit those $100,000 into the donor advised fund, you can go ahead and leave those investments in there if you decide to continue to let those appreciate. That is certainly something you can do. However, just keep in mind that any appreciation post that initial donation are not tax deductible. So once those shares are inside of the donor advised fund, all those assets do go tax free in terms of taxation to you as the donor. However, you do not get a donation once those shares are in that account and are appreciating past what you originally donated. Couple more key points here, and then we'll go over a little example to discuss really some other strategies you can use donor advised funds for. Again, the key point with the donor advised fund is that it does allow one to optimize for both the timing and the amount of your donations. So there can be various times where you want a larger deduction to support whatever charities, causes, churches that you're passionate about. But there may be other times where you may not really, want to pursue that in an ongoing manner. Donor advised funds allow you to still capitalize on those tax deductions and those strategies to the best that you can. So one particular strategy that donor advised funds really allow for is one called bunching. And with bunching, you essentially decide the year that you want to go ahead and get that deduction in because that's really the most important thing as it relates to your income tax. This can particularly happen if you do have a large income year that's abnormal. It may not be something that continues on, and you really want to go ahead and minimize your income tax for taxable income during one particular year. And then you can go ahead and take a standard deduction in future years to allow yourself to really capitalize on that tax savings. So we'll go over a little example here. Those grants, again, can be made out of the donor advised fund over multiple years. However, again, we're really just talking about when that money goes into that donor advised fund for that tax deduction. So in this particular example, we're going to talk about really how bunching would work with someone who has an abnormally fluctuating a couple years worth of income. So this particular slide on the left, we examine a strategy where we're not going to use bunching. And on the right, it's going to be a strategy with bunching. In either case, we have a total donation of $60,000 that we're making to one or multiple charities. On the left here, what this person is really doing is they are taking a standard deduction. So whether they are retired and don't have many deductions to take, maybe they don't have mortgage interest or student loan interest to deduct. Really, the charitable donation is their largest amount of a potential tax deduction. However, again, as we know right now, based on the Tax Cuts and Jobs Act, we do have a very, very high standard deduction, both for married couples and for those single. So currently, under 2024 rules, the tax deduction is $29,200. So unless this particular person's donation plus all of their other charitable or deductions combined were more than 29,200, they would simply take the standard deduction. So while that's great, essentially there is no real realization of this additional 20,000 in terms of an additional tax benefit. On the right, we're looking at that same type of donation, except what this person is going to do is they're going to go ahead and put that $60,000 into a donor advised fund in the first year that they know their income is going to be higher, in this case, $500,000. And they're going to put everything in for that 1 year. They know in their future years they're going to maybe get 150 to 100, around $150,000 for those next 2 years. In those next 2 years, they don't make any donations at all to their donor advised fund. However, what they're doing is they're still granting that same $20,000 that they're doing over here on the left over those 3 years, but they're not getting an additional donation in these second and third years in terms of a tax deduction. However, we can see here over on this far right column, that individual still can take the standard deduction in years 2 and 3 based on IRS rules, regardless of what their itemized donations are. They are getting that larger standard itemized deduction in that first year, even though they're not donating anything in the second and third year into the donor advised fund. That money is coming out as a grant for $20,000 in each particular tax year. So they're still giving that same amount to their church, their charity, whatever cause they want to support. But in the very end, on the right, they're getting in a $118,400 deduction versus on the left, they're getting an $87,600 deduction over the 3 year period. That results in a greater than $30,000 deduction over the course of those 3 years. A couple things to keep in mind. Again, that large tax deduction is taken in 1 year. So whatever amount that you're giving, it can be multiple times throughout that year. It doesn't have to be in just one particular contribution to that donor advised fund, but whatever the sum of those contributions are into the donor advised fund in that particular year is the amount that they're going to be actually getting for that tax donation for their tax return. Deductions are itemized on the taxes in the year of the gift. And then again, we take that standard deduction in those second, third years, fourth year, whatever amount that it is that we need that deduction in. In this particular case, again, this was just a kind of an easy example. We're taking that total amount of $60,000 dividing it by 3. That gives us $20,000 per year. That may be, different amounts throughout the year. In this particular case, we assume that it was an even amount for all 3 years. And lastly, again, no deduction for grants dispersed out of the donor advised fund. So whether you're giving multiple times throughout the year, once those assets are in that donor advised fund and granting them to your church or your charity, those particular grants out really have no bearing on your taxes. It actually does make tax reporting somewhat simpler because you aren't having to keep track of every single donation that you've made to your church, whether it's weekly, monthly, whatever that may be. You're simply reporting the amount that you put into that donor advised fund at the very beginning of that particular tax year, and that's what you're reporting on your taxes. All right. So we've covered the first two strategies here. So lastly, we're going to go into one of the simplest strategies that we have available to us right now in the IRS tax code, and that is utilizing qualified charitable donations. I'm sorry, qualified charitable distributions. Too many donation words floating around here. So qualified charitable distributions are a way that you can again save on taxes and go ahead and donate to a church or charity. Uh, we'll go ahead and dive into those details here. So strategy number three, as we discussed, qualified charitable distribution is, you may have guessed based on the word distribution, is a charitable giving strategy through a retirement account. So this is available for individuals who are over 70 and a half, who have a IRA of some kind. Again, this is not a 401k and this is also not a Roth IRA, but any forms of the tax deferred IRAs, which are traditional IRAs, simple IRAs, or SEP IRAs. You may eventually roll all those into a traditional IRA, but any of those are eligible to take that qualified distribution from. So the reason that these are the simplest and the most tax efficient is because due to the tax reporting of IRAs, IRAs don't have capital gains rules that apply to them. Anything that comes out of a traditional IRA is taxable based on distribution rules as normal income. And so, however, anything that grows within inside of that IRA, that traditional IRA, is tax deferred until you actually take that distribution out. So anything can be done really with inside of that IRA, whether it's investing, whether it's selling, lots of different strategies to make that IRA grow. But once it's basically ready to be donated, that can just be taken as cash, and you really don't have those capital gains tax rules to worry about. The other thing is that you can donate cash directly to the charity once it's actually out of that IRA. So you're not having to worry about selling an investment first. Again, these are most useful for those who traditionally take a standard deduction on their tax return. There's a couple different ways that this is calculated, but anyone who is itemizing or has over that standard deduction doesn't see as big of a benefit with this. However, you still do get a benefit in either case, but those who are taking the standard deduction generally are going to benefit from it the most. This also does satisfy required minimum distribution requirements for those who have reached required minimum distribution age. Those ranges right now, under current law, anyone who is coming into required minimum distribution age, that starts at age 73. However, in recent years, that has changed from 70 and a half to 72, and now at 73. Those will eventually move up to age 75 as well. So those rules are going to be changing depending on your particular age. However, this can actually start at 70 and a half, regardless of when you actually start required minimum distributions, and can still give you the same tax benefits before you actually start taking your required minimum distributions. A couple other key points. This can be accomplished by giving directly from your IRA to your charity of choice. In fact, that's actually an IRS rule. So to qualify as a qualified charitable distribution, those assets must be given directly from your IRA. So you can do that a couple different ways. One that's particularly easy, in my opinion, is that certain custodians can actually give you a book of checks that's attached to that IRA that you want to give out of. And simply, whenever you're ready to go ahead and give to a church or charity of your choice, you can write that check just like you would out of a normal checking or savings account. And that pulls that asset directly or that cash directly from that IRA. And instead of having to sell the stock and transfer to your bank and write a check from the bank. You actually just write it directly from your IRA. Based on the partnership with that particular custodian and the bank that they use those checks for, that still just comes directly out of your IRA and qualifies as that qualified charitable distribution. Another way to do it is if you want to set up multiple distributions on a periodic basis to a church or charity that you like. Your custodian also may go ahead and send that directly for you, and then that's made payable to that church or charity, whether it's a monthly distribution, quarterly, year-end distribution, whatever that may look like. And if you don't want to physically write the check yourself, your custodian can do that based on your instructions. A final one that you can do is to go ahead and set up like an ACH transfer if you have a certain charity or a ministry maybe that you support. And what happens is that ACH can be taken directly off the checkbooks that you get from your church or charity, or sorry, from your custodian. And those ACH instructions, again, will be pulled directly out of your IRA, just like they would be for any other type of ongoing donation that you're making to those causes. So again, any of those three options work, but it does have to be made directly from your IRA. It can't go to your bank account first and then written off of your bank. It does have to be made directly from your IRA. So again, why would we use this strategy? There are really a double tax saving. There's a double tax saving mechanism that's built in to doing this strategy. So under IRS rule, a QCD or qualified charitable distribution is classified as an income exclusion as opposed to a deduction. So an income exclusion is one that's actually taken before adjusted gross income is calculated. For anyone who has had a 401k or something that's a payroll deduction type of a retirement plan, those assets or the amount that you're giving into your 401k, or I'm sorry, deferring into your 401k is taken out of your taxes before you pay those. And so the reason that it's doing that is because it's excluding it from your actual income as if it really never happened. And so the advantage to that is that the exclusion is separate from your standard deduction. So standard deduction is taken after your adjusted gross income is calculated. So again, you're basically getting two lines of deductions in your income. However, again, this qualifies as an actual exclusion as opposed to a deduction. So you can still take, again, if you are taking a standard deduction, then you can take your standard deduction after your adjusted gross income is calculated. And then you've already taken off the entire amount of your qualified charitable distributions. So you're essentially getting the benefit of both, taking a standard deduction and getting that exclusion off of your income for the amount that you're donating directly to your church or charity. One thing to be noted is that when you are filing your income taxes, you do need to actually make the designation on your tax form that this is a qualified charitable distribution, and that is deducted from or excluded from your income. A CPA or a qualified tax preparer is going to be able to help you with that. That is a qualification to make sure that that's not counted into your income when you're making your tax filing. So let's go ahead and go over exactly how this math works on the qualified charitable distributions. On the left here, we have someone who is still donating to their church or charity, but they're taking the standard deduction and it's getting lumped in with the rest of their income. I'm sorry, the rest of their deductions versus someone who is taking that qualified charitable distribution and then also getting a standard deduction on top of that. This particular person's gross income is $435,000, and they're giving $25,000 directly to their church or charity from their IRA. Again, without using that qualified charitable distribution example, essentially everything that they are deducting, whether it's their charitable donation, whether it's any property taxes, mortgage interest, other types of deductions, whether it's anything that qualifies as a deduction really gets lumped into this. If they're under that 29,200, they're simply going to take the higher of those two, which leads to that standard deduction. We're really just doing one deduction at that point. We're taking 435,000 minus 29,200. That gives us a total taxable income of 405,800. Versus on the right here, again, if we have that qualified charitable distribution, basically taking this income off the top directly, our qualified charitable distribution reduces our adjusted gross income to approximately 410,000. From there, we take the standard deduction off of the 410, and then that gives us a total taxable income figure of 380,800 as opposed to 405. So again, a lower income amount means a lower tax paid. We experience a tax savings here of from just over 85,000 to a little over 77,000 for total tax savings of just over $7,700. So again, taking that income off the top and being able to go ahead and capitalize on both types of decreases in income from both the exclusion from the charitable distribution to the standard deduction allows our taxable income to be lower than just being able to take that standard deduction with one decrease in income. So again, a couple of reminders, donations must be made directly to that church or charity. They cannot go to your bank account first and then be donated. Otherwise, they're going to be just lumped into the standard deduction. And then that notation must be made on the tax form when you're filing your taxes, just to indicate that that is that qualified charitable distribution, that you're taking that specific benefit as it relates to that income out of your IRA. One last point here that's not on the slide is that that 70.5 figure is enforced by the IRS. So there is no year that you turn 70.5 or any provision to take that before you turn age 70.5. So if you're 70.5 on July 1st and you take that on June 25th, the IRS can disallow that qualified charitable distribution on your taxes because you have not officially reached that age 70.5 when you've actually made that distribution. So that is important to make sure that you are over age 70.5 when you're actually making that donation. All right. Just checking here before we move on to see if we have any questions that have came in. Let's see here. All right, looks like we had one that just said, what age do you have to start taking your required minimum distributions? So we kind of already answered that earlier, but it is a range right now, unfortunately. There were several legislation reforms that had passed since 2020. Prior to 2020, pretty much everything was based on 70.5. IRS passed several bills, or I'm sorry, Congress passed several bills that were titled Secure Act and Secure Act 2.0 in both 2020 and then a couple of years after that. So the short answer is it ranges from 70.5 to 73 under current law. And then I believe it's another 10 years that actually goes up to 75. So we do have a little bit of time left on that, but that will be going up more so after we get to that 75 mark. All right. And with that, I think we actually are at the end of our slides here. So we're actually going to go ahead and open it up for any other questions that have not yet been answered that anyone has, and we'll go ahead and cover those. Oh, yep, first one here. Let's see. All right, so first question is, how do you go about setting up a donor advised fund? So donor advised fund can be set up at many different custodians. If you are using the corporate custodians donor advised fund service, those can be done at Schwab, Fidelity, I believe Vanguard all have those available. Those are basically, pretty standardized and pretty able to be accessed by any type of individual. I believe they do have a minimum on those. I want to say it's 100,000 to set up those donor advised funds. So they do have some rules that are kind of corporately governed. There are a couple other smaller firms that we actually use that don't have minimums, and we can still set those up at multiple custodians, where essentially the custodian is just holding the assets. They're not actually administering it. In this case, we have the smaller third-party administrator, and then we basically direct the grants as the advisor for you on your behalf, and then those essentially are sent out of the donor advised fund, mailed to the church or charity, whoever you want, and that's how the grants are made. So the short answer is we can set them up really anywhere. It depends on your charitable giving goals. Typically, we use Schwab for most of our donor advised funds, and then another third party to administer those. So, All right. Next question is, how do you transfer shares from your brokerage account to your church? So this particular type of transfer is actually fairly simple. In most cases, the sending firm, whoever own or whoever has your assets currently in your non-retirement account, they have either a form titled a charitable giving request, or the official kind of technical term for the transfer is called a DTC transfer. And you would basically direct your custodian or whoever holds your assets now to say you want to move a certain number of shares of the symbol out to that church or charity. You would need to get the brokerage account number, and then also another four number uh, uh, for character number. I'm sorry. That's called their DTC number, and both those numbers together basically direct the receiving firm to know where to transfer the funds into once they receive them. So essentially, the one brokerage firm sends the shares directly to the other brokerage firm. Once the other brokerage firm receives it, then they essentially deposit that to the correct account at that brokerage firm. So again, you'll want to get the account number and the DTC number from your church or charity that you're sending that to. And then that basically is directions for transferring that in. All right. Let's see here. Another question is, how do you determine the value of your donation if you transfer the shares? So this is a really good question. Based on, the market value of those securities, they're going to fluctuate. If you direct your firm to send those shares out to your charity or your church, that can take anywhere from 2 to 5 business days, depending on how quickly they receive the form. So during that time frame, even though you still hold the shares, they will fluctuate in value based on the market value and the market change of those securities. So there's actually a formula that determines the value of those shares. And what that is, it's actually the average of the high and low on the date that the receiving firm gets those shares. So, if the stock is trading in a range from $110 to $90 in that particular day that they're transferred into the receiving account, essentially your donation would be the number of shares times $100 per share. And that's going to give you that particular market value that you'll be able to use on your taxes for your amount of your deduction. Again, there are some adjusted gross income limits depending on how much that you're actually transferring. I believe it's 30% of your adjusted gross income is actually what you can deduct if you're taking the full fair market value deduction of those shares. So again, there's a couple of rules as far as how much you can actually take on your taxes as a deduction, but the value of the donation is based on the high and the low, the average of the high and the low on the date that they're received. So that that gives you the exact amount that you're able to deduct on your taxes. All right. So I don't see any other questions coming in here at the moment. So we'll give it a few more minutes just to make sure that no one else has anything. In the meantime, just wanted to say thank you for joining us this evening. We appreciate your attendance as we go over these topics and these strategies. We hope that these webinars are valuable to you and that you're able to gain information and insights that can help you in your overall financial plan. We are accepting new clients, and if that is something that you are interested in learning more about with your particular situation, our website can be found with the QR link right here. If you scan that, that'll take you right to our website. We'd love to get to know you, your situation a little bit more, to determine how we can benefit you, how we can add value to your situation. We'd love to book a call with you to understand a little bit more about what's most important to you in your financial life. So again, we appreciate you joining us. I don't see any more questions right now, so we'll go ahead and end just a little bit early here as we wrap up. So again, thank you for joining us. We hope to see you again soon, and have a great evening.